In this video, part of the Startup Tax series, we are going to look at the tax context in Zimbabwe. We'll explore how the system treats startups and the key tax heads every founder must understand, from presumptive tax to pay-as-you-earn. I am Calverwell, and I help startups and SMEs make sense of tax early, giving them the control and confidence to focus on scaling their business. The first thing to note is this. Currently, our laws do not recognize startups or technology businesses as a separate taxpayer category. The only differentiation is by size: small, medium, or large businesses. This is discouraging because startups are essential for economic growth once they are incubated properly. Still, the legislation does allow concessions and credits for new businesses that register formally. And that's the challenge. For most startups, taxation feels complicated and costly. This pushes many to avoid formal registration. And for those who do register, non-compliance becomes the problem. Let's break down the tax heads you need to know. 1. Presumptive tax. This applies to certain trades: transport operators, saloons, informal traders, small miners, cross-border traders, restaurants, bottle stores, cottage industries, and waterborne vessel operators, and many others. It's based on estimated income and has an advantage. No income tax returns are required. But remember, once you file an income tax return, you cannot go back to presumptive tax. 2. Income tax. If you're not under presumptive tax, you must register for income tax. The rate is 25% plus a 3% AIDS levy. Registration requires your incorporation papers and a bank account. ZIMRA then issues a tax identification number, which is your tax ID. Most startups comply with registration. The real challenge comes with renewals. Tax clearance certificates are only renewed for compliant businesses. This means filing returns on time and making the respective payments on time. 3. Value-added tax or VAT. This is an indirect tax on transactions, and in some cases, registering voluntarily can give you input tax credits. 4. Pay-as-you-earn or PAYE. If you employ staff, you must register for PAYE within 14 days. It is not a tax on the business, but a tax on employee remuneration. Still, the administrative burden is on you. You must calculate, deduct, and remit on prescribed dates. Failure to withhold makes you liable for the full amount plus penalties. 5. Withholding tax on contracts. If you contract a supplier without a valid tax clearance, you must withhold 30%. This applies to contracts totaling 1,000 United States dollars or more in a year. If the threshold isn't met, the withholding doesn't apply. Knowledge of the tax environment is the first step in building a compliant, resilient startup. Tax does not have to be a stumbling block. If you plan for it, it becomes part of your strategy. Stay tuned for the next part of the Startup Tax series, where we'll go deeper into how to shape this context into tax strategy.